Right, today we're going to learn about Warren Buffett's views on business acquisition, goodwill, inflation, and Berkshire's hidden value. We'll go through the following. We'll start off with Berkshire's pockets of hidden value. Then we'll go on to talk about what is goodwill and why Buffett talks about two types of goodwill. Then we'll have a look at why a company with more assets is not necessarily a good thing during times of inflation. And then finally, why many companies get it wrong on goodwill. There was a point in time when book value was tied to the intrinsic value of Berkshire. However, the two diverged from one another, with intrinsic value growing larger than book. In the 1983 letter to shareholders, Buffett states two reasons for this. The first was an accounting principle that requires stock purchased through the insurance operations to be stated at the market value, whereas the stock owned by Berkshire was stated at the aggregate of either the cost of purchase or the current market price, whichever was lower. So if Berkshire bought the stock for $25 and the current market price was $50, that would be stated on Berkshire's books for $25. Whereas if it was bought through one of the insurance operations that Berkshire owns, it would be stated for $50. If we take that same scenario, but the stock price had declined to $12.50, then it would be stated on Berkshire's books that both the directly bought stock and the stock bought through its insurance operations was worth $12.50. This accounting principle would have a cumulative effect on the discrepancy between accounting practices of recording securities and the actual value of said securities as time goes on, and especially so with Berkshire because they hold for long periods of time. So reason one outlined by Buffett for the discrepancy between book and the true value of the company is the stocks owned directly by Berkshire that have had unrealized gains through the years which have not been accounted for. The second reason brings us to our case study for today, and that's goodwill. Specifically, Buffett mentions the economic goodwill being far larger than the accounting goodwill stated on the balance sheet. What is goodwill? Goodwill is an intangible asset. It occurs when one company acquires another. It's the excess in price paid over the net tangible assets. You're paying things that are harder to price, such as the reputation, brand, intellectual property, or any commercial secrets. The premium paid on the net tangible assets is what Buffett referred to as accounting goodwill. But Buffett thinks the economic reality can be quite different. As Buffett says, Blue Chip Stamps bought Sears early in 1972 for $25 million, at which time Sears had about $8 million of net tangible assets. Throughout this discussion, accounts receivable will be classified as tangible assets, a definition proper for business analysis. This level of tangible assets was adequate to conduct businesses without use of debt, except for short periods seasonally. Sears was earning about $2 million after tax at the time, and such earnings seemed to conservatively represent the future earning power in constant 1972 dollars. Thus our first lesson. Businesses are logically worth far more than their net tangible assets when they can be expected to produce earnings on such assets considerably in excess of market rates of return. Capitalized value of this excess return is economic goodwill. After you account for the net tangible assets, there is a remaining $17 million left in purchase price. This is your accounting goodwill. Sears was earning an impressive 25% on net tangible assets, and as Buffett says, when a business can earn a higher rate of return than the market, a business is worth far more than the net tangible assets. So the business we bought up turns out to be a great business, and its return on assets is higher than the market average. The difference Buffett would deem economic goodwill. Buffett goes on to point out that it wasn't the tangible assets, such as the equipment, the inventory, location, that produced these results. Rather, it was the intangible ones, such as in this case, the company brand. Customers loved the product and service. Other things that might be considered economic goodwill are governmental franchises not subject to profit regulation, or enduring position as a low-cost producer. So in some ways, the relationship between accounting goodwill and economic goodwill has changed since Buffett wrote on this because of accountancy rule change. That said, the principle that accounting goodwill could be devoid of any economic goodwill because of an over-optimistic management in purchasing another company is still incredibly useful and applicable today. In the 1983 Goodwill Appendix, Buffett also talks about one of the reasons that goodwill is likely to grow is inflation. Buffett has some counterintuitive thoughts on inflation that go against the grain, and to illustrate that, he wants to compare See's Candy with a fictitious, more mundane company. So you'll recall See's was earning $2 million on $8 million of tangible assets. Our fictional, mundane company is still earning $2 million, but on $18 million of tangible assets. So whereas See's was earning 25% on tangible assets, this new fictional business is earning 11% on assets. Buffett states he would expect the mundane business with more than twice the amount of net tangible assets to sell for around $18 million, or for its net tangible assets around that price. So the business has more than twice the amount of assets, but has the cheaper price tag. Remember, Buffett's first lesson, that a business that earns more on net tangible assets are worth more when they have a higher rate of return than the market. And it's those businesses where economic goodwill does exist. Okay, so we now have inflation. What effect does it have on our two businesses? They have to double their earnings, and you might just think, yeah, okay, they can just double their prices and that's that. But then you'd be wrong, basically. As Buffett says, but crucially to bring that about, both businesses probably will have to double their nominal investment in net tangible assets. Since that's the kind of economic requirement that inflation usually imposes on businesses, both good and bad. A doubling of dollar sales means correspondingly more dollars must be employed immediately in receivables and inventories. Dollars employed in fixed assets will respond more slowly to inflation, but probably just as surely. And all this inflation-required investment will produce no improvement in the rate of return. The motivation for this investment is the survival of the business, not the prosperity of the owner. So Suze has 8 million in assets, so it would have to finance a further 8 million net tangible assets, whereas our mundane company with 18 million in net tangible assets has to finance another 18 million. So both businesses are now earning 4 million, but now Suze would be worth 50 million, double the purchase price, because it has the same return on assets, 4 million to 16 million. That means for every dollar invested, the shareholders have gained $3 in value because of the additional 8 million. The shareholder gain is 25 million. The mundane business now is still worth around its net tangible assets, 36 million. So it's paid 18 million to get an additional 18 million. The shareholders have gained $1 for every dollar invested. As Buffett points out, this would be the same achieved in a savings account. The majority of businesses are hurt by inflation, but companies that need less tangible assets to produce earnings are hurt less. A lot of people, when they think of inflation, in regards to investing at least, think their best bet is on some type of commodity company. But because of the low rate of returns, they're subject to many of the issues that Buffett has just outlined. Buffett wrote this in 1983. America had just been through a decade of rampant inflation, so what were the type of businesses that were able to endure? Buffett puts it like this. In contrast, a disproportionate number of the great businesses' fortunes built up during the inflationary years arose from the ownership of operations that combined intangibles of lasting value with relatively minor requirements for tangible assets. In such cases, earnings have bounded upwards in nominal dollars, and these dollars have largely been available for the acquisition of additional businesses. This phenomenon has been particularly evident in the communications business. That business has required little in the way of investment, yet its franchises have endured. During inflation, goodwill is the gift that keeps on giving. That all sounds quite nice, but Buffett also leaves a word of caution, in that it only should be applied to true economic goodwill, not the accounting goodwill found on many companies' balance sheet. What's he referring to? Over-eager management who pay silly prices, far in excess of the company's true value. So how do you know if it's economic goodwill versus the accounting goodwill? Buffett's already given us a hint, but here's the quote. What a business can be expected to earn on unleveraged net tangible assets, excluding any charges against earnings for amortization of goodwill, is the best guide to the economic attractiveness of the operation. It's also the best guide to the current value of the operation's economic goodwill. So the return on net tangible assets is the way to assess whether there's any of the economic goodwill Buffett's been talking about. I'll link the full text in the description below for anyone that's interested. It's definitely worth a read. And yeah, have a good one, guys. Cheers.